Hi, it's Madison Kize. In the previous video, we looked at just working out the splits, the premium splits, beneficiary splits for policies relevant to buy and sell agreements where there's multi-parties involved. So today we're going to be looking at taking those percentage splits that we worked out in part A and now applying it to the cover and just looking at some of the text issues that may have crop up. So as a quick recap, we're dealing with Cheers Liquor Store, which is worth 10 million rands. And we know that the shareholders in that company, there's three of them. There's Sam, who's an individual who holds 15%, Amber 25%, and the Davis Holding Company, which holds the majority at 60%. And that's basically held by Mr. and Mrs. Davis in equal parts. And you'll remember that we had put together three different policies, the one on the life of Sam, one on the life of Amber, and then the one on the life of Mr. Davis, because we couldn't insure Davis Holding Company. So we chose to insure Mr. Davis, who's an individual and can be insured. So if you look at the policy in the life of Sam, for example, we know that the company is worth 10 million rands. Now, Sam's shareholding in the company is only worth 15%. So 15% of 10 million rands is worth 1.5. So that's Sam's value in the share in the company in rand terms. His shares are worth 1.5 million rands. Now, that means that a life policy on the life of Sam for 1.5 billion rands, which is the value of the shares, has to be taken out. Now, we're not going to go into detail at this point because we've covered it in the previous video, but those shares have to be valued together with the claim. And I think let's have a look at that video. I'm going to put a reference down to that video that discusses shares and claim. But for now, let's just work with the shareholding value of 1.5 million rands and assume that there's no claims against the company that Sam has. So the policy that we need is 1.5 million rands. So that means Davis Holding Company and Amber take out a policy on the life of Sam for 1.5 million rands. However, how do they now split it in terms of ownership, beneficiary, and who pays what premium? Now, very important assumption here. Let's assume that the Davis Holding Company and Amber want to buy Sam's 15% shareholding of 1.5 million rands in equal shares. In other words, well, not in equal shares, but in accordance with the current split that they have in the company, which is why we had to work out these figures here. So if for example, they want to keep their current, they want to buy Sam's shareholding, but relative to their current shareholding, where David's holding holds 60% and Amber holds 25%, that means when this 1.5 million rands gets bought, Davis Holding Company is obviously going to buy a bit more than Amber, which is why we had to work out these calculation splits. So because now we've calculated the premiums, the splits in terms of the policy one, from our ownership splits, we know that Davis Holding Company can own 71% of it, and Amber 29%. Now, because it's a pure risk policies, it's less important because there's no underlying value. It only pays out, well, when a death or disability or whatever is insured occurs. So it's less relevant from a pure risk perspective. However, from a pair perspective, let's assume that we've assumed that the company or the policy on the life of Sam is worth 100 rands in the previous video. So that would mean that the Davis Holdings as a company will pay 71 rands of that premium of 100 rands, while Amber only pays 29 rands of that premium. Now, in terms of the life assured, we know that the policy that we need on the life of Sam is 1.5 million. So applying the 71% split to the 1.5 million rands, you get 1,065,000. And then applying this 29% to the 1.5 million rands, you get 435,000 rands. So that's more important for beneficiary perspective. So when it comes to beneficiary, Davis Holdings is going to be percentage 71%, which will equal to 1,065,000. And then under beneficiary for Amber, a beneficiary is going to be at 29%, which equates to 435,000. Now, I don't want to get complicated because we just need a point of reference for now. Some people may decide to take separate policies, but for now, we're just using this as a point of reference. Now, if you take that 1,065,000 plus 435,000, you're back to your initial figure, which is what we needed on the life of Sam, which is a total life cover of 1.5 million rands. So a tricky issue arises now from a practical level. So if you look at the life on the policy, the first one on the life of Sam, we know that we've got the two owners, two beneficiaries, and the payments split in two as well. Now, the premium of 100 rand that we use there on the life of Sam, when debits have could be collected by an insurer, it's impossible, or as far as I know, that no company does this. I stand to be corrected. But that 100 rands, you cannot put two sets of bank details, one for the Davis Holdings company and capture details for Amber as well, together with the 71% split in the same policy and 29% split. And also it just gets complicated. So in order to alleviate that pain, what they could do is that the Cheers liquor store could just use their bank details as just an agent to collect the premiums on the policy in the life of Sam, where they put in place their bank details on their policy, and then they create loan accounts so that that 71% of the 100 rands that is actually should have been paid by the Davis holding company, that in that loan account they can later, as Cheers, the liquor store, they can later collect it from that late loan account. Because so in order to alleviate that challenge, we could just have the bank details on the policy on the life of Sam be that of Cheers, the liquor store, so that the one set of bank details practically just gets captured. And then what the company could then do is create loan accounts, because what's happening basically is that the company is paying the policy on behalf of the owners of the policy, which is David's. The Davis Holding Company and Amber. Those are the true owners, but the liquor store is actually paying the policy on their behalf. But because they're doing that, then they need to create loan accounts where that 71%, that 71 rand that the company pays towards the policy, that they can later collect it from Davis Holding Company because they own the policy. And likewise with Amber, that 29 rands per month, as an example, they have to later on in the financial year end collect the 29 rands times 12, which the company has paid on Amber's behalf, and just get it back from. If that is not done, there are definitely some tax consequences at the end of the year. Because if that is not done, and it's not the topic of today, but they face a couple of options. One of them could be that they simply declare dividends, where they say, okay, whatever the premiums that were not paid, they were not paid back by me as Amber back to the company, let's just declare that as a dividend and take off 20%. So that's how you sort of deal with that tax issue. Or they could just say, assume that the 29 rands times 12, declare it as a salary towards the director and tax it accordingly. So, but that's not the focus for today. That's more Cheers the liquor store issues directly with SARS. But obviously it pertains to the policy. It's just important to be aware of that the minute you set out these loan accounts, manage them properly and accordingly. So I'm going to skip the second policy on the life of Amber and just perhaps focus on the one on Mr. Davis, because it's a bit of an interesting one, and just maybe point you to some of the solutions that some advisors do. So we know that Mr. Davis, through the company, the Davis Holdings Company, holds 60% shares in Cheers Liquor Store. So that 60% shareholding, we know that the Cheers Liquor Store is worth 10 million rands. So therefore, its holding is 6 million rands. Now, if you using these current splits, that means that Amber for the life cover amount we need to take the 62.5% and apply it to the 6 million, and we get an amount of what is it, 3,750,000. So that's a percentage split. And then for Sam, it's 37.5%, and I've worked it out to be 2,225,000 rand. Now, of course, all of this in total equals the 6 million rands policy that we've taken out here. The importance of the split is the way this finance agreement is been structured, is that on the passing of Mr. Davis, that 60% shareholding will be bought by Amber in this split, because Amber holds 25%. She gets to buy a little bit more. So in terms of the policy, she should receive 3,750,000, and Sam should receive 2,225,000. Now, the interesting thing about the last scenario is that on the death of Mr. Davis, we've said that we need 6 million rands. Well, Amber and Sam will need 6 million rands in order to buy Davis Holdings out. But you'll cast your mind that before that policy, that 6 million rands becomes estate duty free, or it doesn't get seen as deemed property. Certain requirements have to be met, and I'll put a link to the description below just to take you through, jog your memory about some of those requirements. But for our purposes, one of them that hasn't been met is that Mr. Davis is actually not a shareholder in this company. So in other words, for the 6 million rands not to be deemed property in his deceased estate, if he was the direct owner of the 60% shares here as an individual, then there would have been no estate duty on the 6 million. However, because he is not an individual and he owns it via a company, there will be estate duty on that policy. So what some advisors normally do is we know that the value of the Davis Holdings company is 6 million rands. Now, for values below 30 million rands, we know that the estate duty is 20%. So you just bump up this cover of 6 million rands to take care of the estate duty. And then it gives you a figure of 7,500,000. I think it is, yeah, 7,500,000. So in other words, instead of selling a policy as policy number 3 and having the sum assured of 6 million rands, you actually make the sum assured 7.5 million rands, so that estate duty is taken care of in that scenario. But again, just remember that this is for estate duty. If the policy has, say, for example, disability as a trigger event as well, there's no estate duty payable on disability. So you can bump up the 7. So the policy could look like 7.5 million rands life cover. However, the disability portion, you don't have to bump up to take care of estate duty. Of course, scenarios will always vary. Like I said earlier on, I'm just using a very simple example just to get some of the concept out there. Cases will vary depending on client to client. It will not always look like this, but at least it gives you a point of reference of how to use the premium splits or the beneficiary splits and apply to the policy, and what some of the tax consequences that could be something to look out for. So I hope that helps, and yeah, we'll see you soon. Thanks.